When I first started looking at price charts, one of the first things I noticed was that price never moves in a straight line. It goes up for a while, then it pauses, then it turns around and moves the other way, and then it does it all over again. These turning points, I later learned, are called swing highs and swing lows. And when I first heard that term, I thought, okay, that sounds simple enough. Just the peaks and valleys on a chart, right? But the more time I spent studying them, the more I realized that something much deeper was going on. Swing highs and swing lows aren't just bumps on a chart. They tell a story. They show you where buyers lost steam, where sellers stepped in, where the market changed direction. And when you learn to read those turning points, you'll start to see something I like to call market structure. And that changes how you look at everything. Now, I'll be honest, this is also one of the most misunderstood ideas I've come across in trading. Many traders use swing points as entry signals. They try to trade every little wiggle they see, and I did that too early on. But that's not really what swing highs and swing lows are for. In this video, I want to explain what they actually mean, how I think about them now, and where they fit in position trading. This is about understanding structure, not finding trades. So, let me start with the basics. A swing high is a price peak. It forms right before the market turns downward. A swing low is a price trough. It forms right before the market turns back upward. In simple terms, these are the turning points in price movement. Every chart you'll ever look at is built from these turning points. If you zoom out and look at a chart from a distance, you don't see random chaos. You see a series of waves, rising and falling, and each one of those waves ends with either a swing high or a swing low. Over time, those points connect and form what I call market structure. And when the highs keep getting higher and the lows keep getting higher too, that's a bullish structure. The market is climbing. When the highs keep getting lower and the lows keep getting lower, that's a bearish structure. The market is falling. And when neither of these patterns show up clearly, the market's just moving sideways. Now, here's what I want to be really clear about, because I think this is where a lot of traders go wrong. Swing highs and swing lows are not signals. They don't tell you to buy or sell. They're not a strategy on their own. They are reference points. They describe what price has already done, and they help you read the market structure. And that's it. I spent a long time early on trying to find the perfect rules for identifying them. Exact formulas, specific numbers of candles, but the market doesn't work that way. Swing points are better understood as a tool for reading behavior, not a mechanical trigger for taking action. So, why do swing highs and swing lows even exist in the first place? And the simple answer is this. Markets are driven by buyers and sellers, and those two groups are constantly pushing up against each other. When buyers are stronger, price goes up. When sellers are stronger, price goes down. But neither side stays dominant forever. And at some point, buyers run out of energy or sellers start to fade. And when that shift happens, price rotates, it turns, and that turn creates a swing point. At a swing high, buying pressure is drying up, and selling pressure is starting to show up. At a swing low, selling pressure is fading, and buyers are returning. These back and forth shifts are what we call the wave pattern we see on every chart. And over time, those waves form a structure. A market that's rallying tends to produce higher highs and higher lows. And a declining market tends to produce lower highs and lower lows. That repeating structure is how we classify markets as bullish, bearish, or neutral. What I really like about swing points is that they come straight from price. No formula needed, no indicator to calculate. The structure is already there in the movement of price itself. And in that sense, I think swing highs and swing lows are one of the most honest tools we have. They simply record the moments where control shifted from one side of the market to the other. Nothing added, nothing filtered. When I look at swing highs and swing lows today, I'm not focusing on any single peak or valley in isolation. I'm looking at how each swing point relates to it before the other one. That relationship is where the real information lives. A sequence of higher highs and higher lows indicates consistent buying pressure. The market has been making progress upward. A sequence of lower highs and lower lows tells me the opposite. The sellers have been in control. I use that sequence as a kind of map. It shows me where pressure shifted in the past, it shows me where participants stepped in, and it gives me context for understanding what's happening now. One thing I've learned that took me a while to fully appreciate, scale matters a lot. A swing point on a 5-minute chart might mean almost nothing. It could just be noise. But a swing point on a weekly chart, that can represent months of market activity, months of buyers and sellers fighting for control. For position trading, That's the level I care about most. The bigger the time frame, the more meaningful the swing structure becomes. I also want to be honest about something. Swing analysis isn't perfectly objective. Different traders looking at the same chart might identify slightly different swing points. And that used to bother me, but I've come to accept it. Because the goal isn't to find the one perfect answer. The goal is to understand the overall structure that price is building. And that structure is usually pretty clear when you step back and look at the bigger picture. The most common mistake I've seen, and made myself, is focusing on swings that are too small. When you zoom in too far, everything looks like a swing point. Every little bump and dip starts to look meaningful. But a lot of that is just noise. It doesn't reflect any real shift in market control. I spent a good amount of time early on labeling every tiny fluctuation I could find, and all it did was confuse me. The second mistake is treating swing points as entry signals. Seeing a swing high and assuming the market has to fall. Seeing a swing low and assuming the market has to rise. Swing points only tell you that price changed direction at that moment. They don't promise anything about what comes next. The third mistake is looking at swing points one at a time. A single swing high doesn't tell you much. A one swing low doesn't either. The meaning comes from the sequence, from looking at how multiple swing points relate to each other over time. One peak doesn't make a trend, but a series of lower peaks starts to reveal something real. And I think the core issue with all these mistakes is the same. Traders focus on individual points rather than on the structure those points are building together. When you zoom out and look at the swing collectively, the chart becomes a lot easier to read. Now, in position trading, swing highs and swing lows play a specific and important role. They help me define market structure. They show me the direction the market is developing. And they help me figure out whether price behavior is consistent with a rally, a sell-off, or a sideways environment. But, and I want to be really clear about this, swing analysis alone is not a complete approach. I use it alongside other tools. I'll look at swing structure together with support and resistance level. I'll cross-check it with momentum indicators. I'll see how it lines up with candlestick patterns or chart formations. Swing points provide context and structure. They don't replace the broader process. They're just one important piece of it. For position traders specifically, the higher time frames are where swing structure really earns its value. On weekly charts, each swing point can represent weeks or months of market behavior. The structure those swings create reflects the big picture, the broader path the market has been taking. And that's what position trading is really about. Not the short-term noise, not the daily fluctuations, the bigger picture, the larger structural move. Swing highs and swing lows read correctly on the right time frame are one of the clearest ways I know to see that bigger picture. Swing highs and swing lows are about as simple a concept as there is in chart analysis. But simple doesn't mean unimportant. In my experience, it's often the simplest ideas that carry the most weight, especially in position trading. These turning points show where price changed direction. They reveal how buyers and sellers have been interacting, and when you look at them in sequence, they describe the path the market has been building. That's not a small thing. That's the foundation of reading a chart with any real clarity. But what I found over time is that when I can focus on the structure, not on individual signals, not on quick entries, but on the bigger picture of what the market is doing, everything becomes calmer, more manageable, and I'm less reactive. And I think that's really the value of understanding swing structure. If it gives you a framework for stepping back, for seeing the market as something that develops over time, not something that demands a reaction right now. If you want to go deeper on this, including how swing structure connects with retracements, support and resistance, and confirmation tools, I've covered all of that in a full article, How to Trade Swing Highs and Swing Lows, 3 Essential Rules, which you can find on positionforex.com. And I'll leave a link in the description. Until next time, best your trading.